Welcome to part 2 of the latest podcast from the Gold Chronicles with Jim Rickards, presented by Physical Gold Fund.
Now, the SDR, the value of an SDR is computed by reference to 4 hard currencies. Now, this is confusing because a lot of people call it the basket of currencies, and I'll tell you what's in the basket. It's U.S. dollars, euros, pound sterling, and Japanese yen. So they're the 4 currencies in the so-called basket. It's dollars, sterling, euros, and yen. But a lot of people think that somehow the SDR is backed by the basket, like there's a big pile of hard currency sitting in a vault somewhere, and that's what's backing up the SDR, and that's not true. The SDR is not backed by anything any more than the dollar is backed by anything. It's just printed by the Federal Reserve. You take it on faith. But you have to decide, well, what's an SDR worth? If I want to buy an SDR, how many dollars do I have to pay, or how many euros do I have to pay? Well, that's where the formula comes in. That's where the basket comes in. It's a 3-step formula. It's not that complicated, but basically you take the 4 currencies, you weight them, and in round numbers, it's about 41% for the dollar and 37% for the euro and about 10% each for the yen and for sterling. A little more than that. It has to add up to 100. I don't have the numbers in front of me, but they're approximately what it is. And then that's your initial weight, and then you convert it into a slice of each currency that would add up to 1 based on current exchange rates, and then you convert those to dollars, also based on current exchange rates, and then you add them up, and that's how many dollars an SDR is worth. Right now, an SDR is worth about $1.40, but it fluctuates. I mean, it wasn't that long ago. The SDR was worth about $1.50. The fact that the SDR is down in dollar terms is actually a symptom of the strong dollar. Same reason gold and oil and the euro and Australian dollars, the Canadian dollars and Chinese yuan and copper and everything else you can think of is down is because the dollar's up. So it's just the inverse. The dollar price of anything is just the inverse of the strength of the dollar, and so the dollar price of the SDR is down. But it's still a fiat currency. It's still, as I say, something they just print and hand out. So the big play now is China wants to join that club. And that's how I describe, a couple ways I describe it. One is you're joining a very exclusive club. There are only 4 members of the club right now. Very exclusive. You want to be the 5th member. So China's kind of knocking on the door trying to get into the club. And then they're going to be allowed in. This is going to play out over the next year. The executive committee of the IMF will announce this green lighting sometime in a matter of days. The actual official announcement, so the executive committee is just saying, yeah, we're okay with it. Now go ahead and make it happen. They'll say that to the staff, and then the actual official announcement will come around the end of March 2016, and then the effective date is when does this actually become part of the SDR? The answer is September 30th, 2016. So this is really a slow rollout, partly to give large institutional investors time to adjust their portfolios. A lot of investors weight their portfolios using the same weights as the SDR. Well, if you suddenly introduce the Chinese yuan in the basket, and it always has to add up to 100%, that means you've got to reduce the other one. So who's going to take the haircut down a couple of days? It all remains to play out, but it does mean that big institutions are going to sell assets in certain currencies and buy assets in yuan in order to rebalance their portfolios to match the SDR. And so that's actually a trading opportunity if you want to figure that out and get ahead of that a little bit. But so that's what's going on. So that's what we mean by China being on its best behavior. But best behavior, as the IMF defines it, means an open capital account and a freely usable currency. That's that phrase, freely usable. That means you have to be able to use it in trade, settling balance of payments. Countries need to be able to get it to buy reserves, or if they have it, because their countries ran a surplus with China, they want to be able to swap it into Swiss francs or dollars or anything else. So this announcement is a big one. It's important. But they've been setting up these bilateral currency swap arrangements with Brazil and a lot of other countries for a couple of years now, all with a view to opening their capital account. Now, is this good news for the dollar? Absolutely not. I mean, the more the dollar is pushed aside as the leading reserve currency and as the leading trade currency, and I would make the point there's a distinction between a trade currency and a reserve currency. A trade currency is what you use to buy and sell stuff. It's fairly obvious. A reserve currency is where you park your savings. So if you're a country and you run a surplus and you earn currencies, you earn a surplus through your trading activities, what do you invest in? What stocks and bonds do you buy? And what currencies? Do you want to go buy, Greek sovereign debt? Maybe that's not such a good idea. Do you want to buy U.S. Treasuries? Yeah, that's the number one choice in the world, and so forth. So that's the reserve currency status. They're related because the more liquid you are in trade, the more likely you'll have a bond market that people can invest in, and that all that liquidity connects. But right now, the usage of the yuan in trade is much greater than its usage as a reserve currency. They still have ways to go there because they don't really have a big bond market, but they're working on one in London. Xi Jinping, the president of China, was just in London at a euphoric reception. Was treated like a rock star in New York in mid-September, and felt completely ignored. The diplomatic chatter there was that the guy felt insulted because he wasn't, it was his first state dinner in Washington at the White House and all this stuff. Felt that the Obama administration kind of dissed him. My advice to Xi Jinping is don't come to New York the same week as the Pope. I mean, the Pope got a much bigger audience than the president of China, but that was bad protocol by his guys. But be that as it may, Xi Jinping went to London and was treated like a rock star. And now we're seeing London kind of move away from the U.S. a little bit and say, well, look, London's been the financial center of the world for 250 years. They want to keep a good thing going, and if China's the financial power and China's buying the gold and China's going to have the new reserve currency, then why not cozy up to the Chinese? And they are. So just to kind of wrap up the segment, I would say that China's doing everything right by the IMF and is being green-lighted by the IMF, and is working not just with Switzerland but London and other financial centers around the world to increase the liquidity and convertibility of the yuan. But none of this is good for the dollar, because as the dollar is diminished, that means that at the margin there's less and less confidence, and that brings us closer to the day when people lose confidence in the dollar completely.
Well, now let's shift from China to India. The Prime Minister of India, Narendra Modi, has just announced a gold deposit plan designed to pull gold into the mainstream financial system by allowing banks to pay interest on deposits of physical gold. What's your take on this, Jim? Is it a local curiosity, or could India's initiative have an impact on the global market for gold?
This story is my favorite story, I don't know, the week, the month, the year. I love the story because it is such a outrageous, bodacious, transparent fraud for a sovereign government, the Prime Minister and Finance Minister of a sovereign government to try to pull. But I will say, and I'll explain why, we'll get into it a little bit, but I do have complete confidence in the Indian people that they're not going to fall for it. I would say any citizenry, any people who were smart enough to buy 20,000 tons of gold in the first place are not going to be dumb enough to hand it over to the government. So I think this will fail, but I think it's very revealing as to why they're even trying it. So let's take a step back and just kind of, for the listeners, talk a little more detail about what we're talking about, and then I'll give my analysis. So this is proposed legislation, and it's important to understand that in a parliamentary system, if a prime minister with majority control wants something, they usually get it. It's not like the United States where, the president can go to the Congress and the Congress will say, shove off, we're not voting for that. Where the Congress can vote for something and the president says, the heck with you, I'm going to veto it. I mean, the U.S. has a completely dysfunctional relationship between the legislature and the executive where they're barely talking to each other. That's not true in parliamentary systems, as you know. So if the Prime Minister and the Finance Minister are in favor of this, which they are, and they said so publicly, then I think there's a good chance this will actually become law. Now, what does it do? And by the way, I've had this debate for years because I tend to look at official gold. When I say official gold, the amount held by a central bank or a sovereign wealth fund or a finance ministry or whatever's under government control. And that's a much smaller amount than all the gold in the world. So these are estimates, of course, but it's estimated that all the gold in the world, I'm talking about above ground, so not mining reserves or things like that, but actual gold that's either in bullion or jewelry or some industrial application, is about 180,000 tons, which is not a lot, by the way. I think a lot of listeners know it would fill up like one or Olympic-sized swimming pool, but not much more than that. That's all the gold in the history of the world, so it's actually extremely scarce. But the official gold is only about 35,000 tons, so it's a small fraction, only about 20% or less of the total gold. So that's where things stand. Now, So I say, India only has about 500 tons of official gold, which is not very much for the size of their economy, and the U.S. has a lot more actually relative to its GDP. And the economic entity that has the largest amount of gold relative to the size of its economy is actually Europe. The 19 members have about 4% of GDP in gold. The number for the U.S. is about 2.7. Same for Russia. China officially is less, unofficially probably closer to the 2.7. India is a lot smaller than that. Their numbers probably pretty good. So let's say it's 20,000 tons. So the plan is the government's working through the banking system is going to create a new, mostly what would happen is Ms. Indian bride or Ms. Indian widow or housewife, you take your gold, bring it down to the bank, hand it in, and they give you a certificate. And the certificate pays interest. This is always the wrap on gold. It doesn't have any yield. Well, I would say gold's not supposed to have yield because it's money. Money doesn't have yield. If you want yield, you got to take risk, including a bank deposit. But anyway, the myth prevails that not having yield is an issue. So give us your gold, and we'll give you a certificate that pays interest. But if you ever want your gold back, come back down, and you can cash it in, and we'll give you the gold back. Beyond that, then the banks are allowed to lease the gold. Now, think about this for a second. This is 20,000 tons of gold. It's 2/3 of all the official gold in the world. By the way, as I said, I don't think the Indian people are going to fall for this. And this gold, this 20,000 tons, this includes all the gold in all these Hindu temples and Sikh temples. I was in Malaysia recently, and I went to a Hindu temple. They had like a 40-foot high statue covered in gold. So it's a lot of gold in temples. I don't think they're going to be melting down the temple gold anytime soon, so I wouldn't expect that. But just the gold that people might have in jewelry and coins and bullion and kind of stashed away somewhere, even if that's half the total, still 10,000 tons, which is almost a third of all the official gold in the world. So people are supposed to hand in their gold, get the certificate, but no worries, you can always get your gold back. But then the banks can lease it out. But now we're into what's called fractional reserve banking, and this works exactly like unallocated gold from the London Bullion Market Association. By the way, it's the opposite of physical gold fund. Physical gold fund, our host, if you invest with them, they buy the gold, and it's your gold. It's got a serial number. You've got a manifest, and if you want the gold, they'll send you that exact gold. So there's kind of no monkeying around with how much gold they have relative to how much investment they have. It's one for one. But what banks do is, let's say a bank gets a ton of gold, they'll go ahead and lease it out. They'll lease out 10 times as much, and they'll only hold a small reserve relative to the amount of gold entrusted to them. That's what fractional reserve banking is. That's been the way banks work since the 14th century. It's one of the most successful frauds in history and still going strong. So what's the point of leasing gold to Indian jewelers? Well, the reason they say they're doing this is because India has massive trade deficits because the people keep buying gold. Now, the jewelers are in India and the consumers are in India, but India doesn't have any gold in the ground. They've got, say, 20,000 tons of gold that they're wearing around their necks, but there's no gold in the ground. So they have to import it because all the people who have it won't sell it. So if you're a bride and you got a bunch of gold for your dowry, you're going to have that gold till the day you die, and you're going to give it to your daughter or some family member for their dowry, and hopefully accumulate it over time. So every time a new bride wants some gold and wants to get a dowry, they have to import it. The imports drive India into a trade deficit, which is what the finance ministry says they're concerned about. So think about the idea. So you go to the Indian people, say, give us your gold, we'll give you a piece of paper. And then the bank says, I'll lend the gold to the jeweler, and the jeweler will make a nice necklace that the bride can buy for her wedding day, and we don't have to import the gold, so that'll make our trade deficit go away. That's what they say is going on. But think about that. They're taking a necklace from one bride, leasing it out to somebody else, making a necklace for another bride, and both brides think they have the gold, right? You get two people who think they have gold, but there's only one piece of gold. I took it from you, I refabricated it, I sold it to somebody else. You think that you can come down to the bank and get the gold whenever you want. The bride thinks that she's got the gold because it's around her neck. So you got two people who think they have an ounce of gold, but there's only 1 ounce of gold. Welcome to fractional reserve banking. Welcome to unallocated gold. Welcome to the gold fraud. Welcome to gold manipulation. This is how they do it. Now, what you hope is that all those people with the certificates don't run down on the same day and ask for their gold. That's a run on the bank. That's been the problem with banking all along. And it's not just gold. It can be paper money or bank deposits or anything else. If everybody shows up at the same time, they can't get their money. Unless, with paper money, the Fed can print some, but with gold, you can't print it. So we're going to a fractional reserve system for banking, for gold rather, intermediated by the banking system. It's a kind of a fraud because you're going to have multiple people who think they own the same ounce of gold, but there's only 1 ounce to back it up. Some of it exists in paper form, some of it exists in physical form. There's a lot of, mystical, intermediation going on in between that no one quite understands. So that's one thing that gives me pause. But there's something even bigger here, John, which I think is important. I obviously talk and write and speak about gold quite a bit, and I've forecast much higher prices for gold, which, I stand by because it's 8th grade math. Just look at how much paper money, how much gold is there, and divide one by the other, and hypothesize the loss of confidence in paper when you need gold to restore the confidence, and what is the implied non-deflationary price, and it's somewhere between $10,000 and $40,000 an ounce, going up all the time because they keep printing money all the time. So that's kind of easy to analyze. But then people say, well, when's that going to happen? How come it hasn't happened yet? And the answer is that there's enough gold around to maintain the price suppression, which is done. We know how it's done. It's done through leasing. It's done through slamming the futures market. It's done through unallocated gold forwards. It's done through fractional reserve banking, the way I just described. It's done through a lot of ways. Some of it's done through counterfeiting, frankly. There's some evidence of that. But meanwhile, in the real world, away from the world of paper gold, in the world of physical gold, we know what's going on. China's been buying thousands of tons. Russia has bought over 1,000 tons in the last 6 years. China's bought 3,000 or 4,000 tons, probably more. Smaller players from Vietnam to the Philippines to Mexico to Malaysia, Turkey, Iran, they're all buying gold. And so gold, physical gold, is disappearing. So I've said all along that where I thought it would break down is not because, the COMEX traders stood for delivery. Why would they do that? They make money on the roll. They're going to keep rolling over the contracts. Why do they want to mess it up? The bullion banks aren't going to mess it up. They make a lot of money doing this. So all the players in the system have no interest in shutting down the system because they're making money doing what they're doing. Why would they want to mess with that? And Americans don't understand gold. Americans don't have gold. The government doesn't talk about it. So you put all that together, it's hard to see what's going to cause this inverted pyramid to tip over. But one thing I've said is that what I do think could start the buying panic and the super spike in the price is a failure to deliver. There was some place, somewhere, sometime in the system, we have something that looks a little bit like MF Global or Refco or one of these big brokers going out of business, and they owe a lot of people a lot of gold that has been demanded, and they can't deliver. And those people don't get their gold. Those people they might get a check, they might get a bankruptcy claim, they might have to go show up in court and press their claim, but they're not going to get their physical gold. And when that becomes widely publicized, everyone else in the world will be, wait a second, what happened to the gold? And they all run down and demand it, and the whole system implodes. So that's kind of how I see that playing out. Well, that won't happen as long as there's enough gold to go around to keep the game going. But what if there isn't? I mean, India is a major country. It's 1 billion people. It's not an unsophisticated jurisdiction. The head of the central bank is one of these MIT PhD cronies, along with Yellen and the rest of them. He's a very, very well-regarded PhD economist who's in this club of global financial elites. They know what they're doing over there. So when I see them kind of making a blatant grab for even 10,000 tons of gold, it tells me they're getting desperate. It tells me that the physical gold is disappearing. By the way, you asked in your question, John, you said, is this a big deal? I don't see it being successful because I think the Indian people are too smart for that. But if I'm wrong and they get suckered into handing over their gold, it's a very big deal because all of a sudden you're going to have another 10,000 tons that you can, lever 10 to 1, which is 100,000 tons that you could lease out in paper transactions. So it could keep the game going. So I still like gold for a lot of reasons. I like it for insurance reasons. I think it's a good store of wealth. I can make that case at length. If this actually works, is it good for the price of gold? The answer is no, because it's going to give the power elites and the central banks and the sovereigns more physical gold to play with to fend off the day when somebody drops the ball and you can't find the physical gold. Having said that, I mean, that's the right analysis, but having said that, I smile a little bit because I really do think the Indian people are too smart for this scam.
Thanks, Jim. And now Alex Stanzik is here with questions from our listeners.
Thanks, John. Jim, just thinking about your comments regarding India, when this all started happening, or where they started talking about it a couple of years ago, I was thinking the exact same thing in regards to, wow, if they actually were able to monetize some of this Indian gold, this some 20,000 plus tons or whatever it is, that would give them a huge amount of leverage in order to deploy that into the market through leasing, just as you had mentioned. And it occurred to me at the time that if they were able to figure that out, that could be a huge problem. After thinking about that further, I realized that the Indians are buying gold for religious purposes and traditional purposes, but I think one of the other reasons why they buy and hold gold is to store value, because they don't really trust the banks or the government. So I don't know if they've thought that all the way through, but it's a really interesting story.
Yeah, I think you're exactly right, Alex. I mean, I'm all for religion and tradition, but I think Indians buy gold because it's a store of wealth that you can't inflate, you can't hack it, and you can't make it go away. And other than outright confiscation, this is confiscation with a smiley face. By the way, once the bank got the gold, I don't think it's going to work. But if it worked, if the bank got the gold, and you actually showed up in a panic with your little certificate in your hand and said, "Give me my gold, please," they'll just shut the bank. So they'll say, "Oh, sorry, change the rules, force majeure, you can't have your gold." So these people will never see their gold again. But I do think that they understand that. And also, just for the benefit of the listeners, I said, if the central authorities, the global financial elites, had another, let's say 10,000 tons of gold to play with, could they keep the game going? Could they keep the manipulation going? Yeah, it would give them some fresh ammunition to keep the manipulation going. But I would make another point, which is that when confidence breaks, no amount of reserves are enough. In other words, looking at China's reserves being drawn down, I mean, there's a run on the bank going on in China. They had the famous $4 trillion equivalent of reserves. They lost $500 billion in about 6 months. Those reserves are running out the door. China's desperate to prop up the yuan because everybody wants to sell yuan, buy dollars or buy Canadian dollars, buy Australian dollars, get a condo in Melbourne, get a condo in Sydney or Vancouver, Istanbul, Rome, London, New York, San Francisco, you name it. The rich and the elite in China are getting their money out as fast as they can. So $4 trillion sounds like a lot of money until everybody wants their money back, and then you find out it's never enough. So even with more gold to play with, when the panic hits, when the gold buying panic hits, when the super spike comes, it'll fall apart quickly. No amount of gold will be enough to save you.
That's very interesting, and I happen to agree. As a side note, the COMEX futures, etc., they basically have it in their rules already. Exactly what you said. When people come and ask for delivery, they can basically just say, "So sorry, we're not going to do that." So
there's everyone's accuses them of changing the rules, but I remind people, I'm actually enough of a geek that I've read all these rule books. They have a rule that says they can change the rules. So they would say, well, we're not really changing the rules because we have this rule over here that says we can change the rules. So don't ever rely on the futures exchange promises.
That's really funny. If it were Monopoly, who would even play, right? Okay, so getting into some of these questions, we have, as usual, we have a ton of questions in the queue. We're going to try and answer as many of these as possible, but we will not be able to answer all of them. So we'll get started with the first one. I'm going to kind of paraphrase this question because I think this gentleman's first language might not be English. It's coming from LS, and his question is, if there is a global financial crisis, how will clearinghouses be affected? And in addition to that, will we be able to get our funds back if these brokerage houses have problems or issues?
I'm not sure what language the person writing is coming from, but that was a pretty clear question to me, and the answer is no. Now, just take the last two extreme financial crises. I'm not talking about market drawdowns or various panics of the past that they've happened throughout history, but I'm speaking specifically of 1998 and 2008. They were 10 years apart. Of course, 1998, I had a front row seat. I negotiated that bailout for long-term capital management. Sponsored by the Federal Reserve. And then 2008, I think most of the listeners, it's painfully fresh in their recollections. They know what happened there. But in each case, markets were, in the case of 1998, hours away from shutting down completely all over the world. In 2008, probably a couple of days away because nobody wanted to get that close because there was even more at stake. But these panics were so severe and the liquidity crises were so severe that they used extraordinary efforts, bailout efforts, In 98, Wall Street bailed out a hedge fund. In 2008, the central banks bailed out Wall Street. So coming ahead 10 years, say to 2018, if not sooner, in the next financial panic, the problem keeps getting bigger. In other words, 98 was severe enough to threaten a shutdown of every market in the world. And that's not an exaggeration. Greenspan and Rubin testified to that. I saw it firsthand. Now, in 2008, however, it was even bigger than it was in 1998. And it wasn't, Wall Street couldn't do the bailout. The central banks had to bail out Wall Street. Now, the next time, it's going to be bigger than the central banks, because the central banks have bloated their balance sheets. They've used up all their dry powder. The $4 trillion that the Fed printed to bail out the system the last time is still on the balance sheet. They haven't done anything to reduce the balance sheet. They haven't normalized anything. And the same is true, even more extreme form, for the People's Bank of China, the ECB, and the Bank of England, and the Bank of Japan. They've all exploded exponentially their balance sheets. So they've got very limited capacity to do it again. And so who's going to bail out the central banks? Well, the answer is the IMF. Is one way to do it with SDRs, but the other way to do it, and I think both of these things will happen, is just to shut down the banks. In other words, the best description of a financial panic I've ever heard is everybody wants their money back. Think about that. Everybody in the world wants their money back. And when times are good and you have the appearance of liquidity, people think of everything as money. So they have money market funds. Oh, I can call my broker today and the money will be in my account tomorrow. Well, what if I shut down the market tonight? You're not going to have the money in your account tomorrow. In other words, it's only money if it's physical gold, or if you have cash, or you have access to an ATM or something. Everything. I'm not saying you should have 100% of your wealth in that. I don't believe that. I recommend 10% in physical gold. Just understand that anything that's not gold or cash is not money. You have some kind of counterparty risk, some kind of potential to be told, sorry, I'm not going to give it to you right now. And that's what's going to happen. So I would expect that banks and brokerage firms would be shut down, that ATMs would be reprogrammed to dispense $300 a day for gas and groceries, and the government would say, well, why do you need more than $300 a day? That's enough to eat and put gas in your car and get to work, so we'll get back to you about the rest of your money, but you don't need it right now, and we're not going to let you have it. So that's not a reason to sell everything and pull your money out of the bank and stick it under a mattress, but it is a reason to have some of your net worth in physical gold or silver or cash. But although it's really hard to get cash because of the war on cash, and people ask me how the war on cash is going, I say it's over. The government won. But be that as it may, you do want 10% of physical gold in readily accessible form outside the banking system, because when the crisis comes, they're going to shut down the banks.
Okay, that's very good. To take that thought just a little bit further, the thing about liquidity, the IMF says that the gold bullion component of monetary gold is the only case of a financial asset with no counterparty liability. So I read that to say they even consider cash or the money of sovereigns to be not quite in the same category. And then
well, that's right. I mean, just pull a dollar bill or a $10 bill out of your wallet and read it. A piece of paper money, and everything in the bank is just a digital representation of the piece of paper. But where I went to law school, they always said read the contract. Well, a dollar bill is a contract between you and a central bank. So read the contract. It says Federal Reserve. Where I went to law school, a note was a liability. And if you look at the balance sheet of the Fed, that's where you find it. The money is on the liability side of the balance sheet of the Federal Reserve. So I think of what most people call money or paper money or a dollar bill, or even if it's in the bank in digital form, I think of it as a perpetual non-interest bearing liability of an insolvent bank.
So I think we have time for maybe one last question, if we can squeeze it in here. There's been a number of people asking about negative interest rate policy. Now, I know you've commented on this, but kind of as a tangent to this. This question is from Dean M., and he's saying that, Jim, you talk about possible QE4 in March of 2016, but you also have mentioned negative interest rates. I think he wants to know which is more likely and why.
What I've said is March 2016 is my estimate of when the Fed will have to ease. Of course, the whole world is expecting them to tighten in December, But my view is they've been tightening for 2.5 years, and we're now getting close to recession, so they're going to have to ease. Now, there are 5 ways for the Fed to ease. One of them is negative interest rates, which makes you want to take your money out of the bank and go spend it, because if you leave it in the bank, they're going to take some of it as negative interest. The second way is QE4. Third way is forward guidance. Fourth way is currency wars, which is you cheapen the dollar. And the fifth way to do it is helicopter money, which is a combination of fiscal and monetary policy, or QE for the people, as Jeremy Corbyn calls it in the UK. So you have negative interest rates, QE4, forward guidance, currency wars, and helicopter money. Those are, the Fed's actually not out of bullets. They have 5 ways to ease monetary policy even when interest rates are 0. Now, I expect forward guidance. The listener, I think, said I've been predicting QE4. Actually not. I have been predicting ease. Yes, that's right. I have been predicting ease. But I think the way they'll do it is by reinstating forward guidance. Because forward guidance is the easiest one to do. That just means sticking a word in the statement, like patient. Last time they had patient. Now they'll come up, what's the synonym for patient? I don't know, look it up in the thesaurus. Forbearance, or, super patient or something. But they'll do something like that, just stick it in the statement. That's a message to the markets. It's saying, hey, not only are we not raising rates at this meeting, we're not going to raise rates for at least 6 months, maybe longer, so knock yourselves out. Put on the carry trade, risk on, invest in emerging markets, buy stocks, get margin loans, whatever. All the stuff people have been doing to prop up the markets for the last 7 or 8 years it'll be risk on again. And so, the risk of borrowing short and lending long, of course, I borrow overnight. I convert my dollars to some, emerging markets currency. I go buy into some stock market that's going up a lot, and I leverage the trade, and I make 50% returns on equity, and I tell everyone I'm a genius, when in fact all I'm doing is making an incredibly risky leverage bet in cross currencies. Now, the risk of the trade is that short-term rates go up. My cost of carry goes up, and I got to unwind the trade, sell it, pay back the dollars, because I'm short dollars in that situation. Well, but if the Fed says, hey, we just took that risk off the table, we got your back, go knock yourself out, because when we use forward guidance, we're telling you we're not going to raise rates, so you can do this trade safely, at least till we say otherwise, then that'll get the game going again. So that's actually what I expect. It's funny that you can tighten and ease just by sticking a word in the statement, but that's how messed up things are. I actually don't expect QE4. The academic research is starting to come in on QE1, QE2, and QE3. Most people, and I agree, actually most people think QE1 served a purpose. That was a necessary liquidity response to a liquidity crisis in 2008. That's what central banks are supposed to do. But QE2 and QE3, that was just pure experimentation by a mad scientist named Ben Bernanke. Now that the academics are looking at it, they're starting to conclude that it didn't really do any good, except it blew up the Fed's balance sheet, created asset bubbles that are going to burst and cause the next financial panic. But so QE is kind of getting a bad rap. I doubt they'll go to QE4. I don't think they'll use negative interest rates. They could. They are using negative interest rates in Europe and Switzerland right now, and I think soon in a few other places. But I don't think you'll see negative interest rates in the U.S. The reason is that the U.S. has a huge money market industry, which is not true of the rest of the world. Money markets are kind of a uniquely U.S. phenomenon. And money market funds can't run on negative interest rates. They need some positive carry so they can charge fees. Remember, they got to take a little spread just to keep the lights on, pay the administrator, pay the lawyers, pay salaries, and kind of protect their front and baloney jobs. So you need some positive carry. If you go to negative rates, you'll completely destroy a $1 trillion industry. So they probably don't want to do that. Currency wars, yeah, I think that is on the table. Helicopter money, I don't expect it. Helicopter money is when you spend more money, you increase the deficit, the Treasury covers the deficits by borrowing, and then the Fed buys the bonds by printing money. So it's a different form of QE. You're printing money, but you're doing it specifically to monetize deficits, and that's the spending that's designed to ease monetary conditions and give the economy a lift. The problem with that is it requires cooperation of the White House and the Congress to enact whatever fiscal policy they want to do, and the White House and the Congress, as I mentioned earlier, are barely on speaking terms. So I think politically that's a tough one, especially in an election year. So I think negative interest rates, QE4, and helicopter money are unlikely, but not impossible. I think a cheaper dollar and forward guidance are the most likely, and I think we'll see those by, probably by March or shortly thereafter.
Okay, and that about wraps up our time. So, Jim, I just wanted to thank you as usual. Great job. Appreciate your time. And I will turn it back over to John.
Thank you, Alex. And thank you, Jim Rickards. It's always a pleasure and an education having you with us. Most of all, thank you to our listeners for spending time with us today. Of course, you can also follow Jim on Twitter. His handle is @JamesG.Rickards. So goodbye for now, and we look forward to joining you again soon. You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.